So the market is lower with trade uncertainty and stress of these big momentum names, folks. Look at these hits over just the last few days. And I got to tell you, this morning, JP Morgan came out, defended Netflix, in fact, gave it a target of 465. And Amazon also got an upgrade at Wells Fargo. Also, a poor IPO performance like the Peloton deal yesterday. By the way, I think that's great news. I mean, it means smarter investors are not taking the bait on some of these things. They're not ready to be monetized by Silicon Valley and Wall Street and by these overpriced IPOs. I want to bring in to discuss all of this, though, SureVest CEO and Chief Investment Strategist Rob Luna and Kingsview Wealth Management CIO Scott Martin. Scott, I got to start with, though, the names that have driven up everyone's portfolio in the last 4 or 5 years, and that's these big momentum names, the Netflix, the Amazons, the Facebooks of the world. What is going on?
Well, I mean, they're heavily cap-weighted, most of those indexes you're talking about, Charles. So the big companies, when they go up, they drag the index up more than some of the other companies. But why are they going down so much recently? Well, you know what's funny, Charles? We've seen this movie before. In fact, we've seen it quite a bit over the course of the last couple of years of this bull market. Is the market gets in moods. I think that's one thing that's important as we tell our investors, Charles, is that there's just times when stocks don't want to go up. And I know that sounds trivial, but it's true. And sometimes these momentum trades, to your point, get reversed. But I will tell you that if you look at the fundamentals, if you look at valuations in the marketplace, look at interest rates, look at Fed accommodation, there's many more things I could say there along that line. I believe that still is providing a lot of support for some of the big cap names in the S&P 500 and NASI.
Rob, Scott brought up valuations. There's some thinking on the street that maybe, these are great companies. They just got ahead of themselves. Their valuations are just a little bit too high, and we can no longer afford them those outsized valuations. Do you agree with that?
Yeah, I think so. I mean, some of these stocks have had a tremendous run-up, as you know, Charles. I think the market's in a place right now. Look, technically, we're bumping up against resistance. We know the only thing that's going to get us through those levels is a China deal. And, we thought maybe when we heard that October 10th meeting date, the market got extremely excited about that. But then today we heard what's going on from Trump in terms of investment into the U.S. from China, and everything took a leg down. So I think until that gets done, these high-valuation stocks are going to come under pressure. And if you look at a company like Netflix, I think that's got its own issues. That stock's down, 25, 26% in the last month.
Now, and to your point, we have Netflix at the lows, the market's at the lows. It's the October 10th date does loom large because it gives President Trump a chance to implement the next round of tariffs if things go well. So you're absolutely right. All eyes will be on that. In the meantime, Scott, are there any of these names, since they have been pulling back, that look attractive to you?
I like Amazon here, Charles. Amazon's been struggling the last few weeks as well. Not as bad as Netflix, but hasn't been performing all that well. Facebook, too, just given some of the litigation that's hanging out there. Whenever you get a pullback in Facebook by a couple percent on some headline risk, let's call it, I believe that's an opportunity to enter because, like I commented previously, Charles, those are two companies that, yes, I agree, valuations are, in a word like the kids would say, maybe whack on some of those names, but you're paying a reasonable price for them in the sense the multiple is fair to me because of the fact that they have such top line and bottom line growth. So when you have companies that are trading expensive, look at some of the growth prospects they have, free cash flow numbers that both of those names have, and it's worth it to pay high price for.
Rob, real quick, these IPOs, they've been, for the most part, it's been pretty disastrous. Lyft, Uber, the names go on and on. I think it's great that individual investors aren't taking the bait, but some people say, well, this is reminiscent of the top back in the old tech bubble.
No, Charles, I think you're exactly right. I think this is actually a good thing from the market. One of the challenges, though, for investors, in 2000, we had 5,800 publicly traded stocks. Today, that's 3,800. So there's a third less availability in terms of stocks for the average investor. So people are hungry for these new deals. But we've talked about this before, Charles. In 2000, when stocks used to go public, they were going public really to raise capital. Today, it's a liquidity event. The private markets are so big that all the money's being made in those markets, and it's a dumping ground for public investors.
Great point. Real quick, Scott, we had a lot of economic data out today. For the most part, all beat. Durable goods beat. Personal income was in line, but strong. Michigan consumer sentiment beat. The consumer is strong enough to keep this economy and market going?
Yeah, it's strong enough to keep it here, Charles. You know, I'm not so sure, and I agree with Rob's point earlier. I don't think it's going to push us above, say, the all-time highs in the S&P, you know, give or take about 30.25, 30.27 if you're picking points there. But the consumer's strong enough to where bad economic data that comes out that's maybe unrelated to the consumer, or certainly more troubles with China, I believe the consumer hangs us in here from at least some sort of bigger collapse.
Scott, Rob, gentlemen, thank you both very much. Have a great weekend.
See ya.
Thanks, Charles.
Hey, some